a dire outlook for the U.S. economy. I'm your host, Steve Van Metre, and thanks for joining me today. And one Harvard economist says that it's worse than we thought. Let's over we pick today's story up with a headline that Harvard economist and former chief economist for the IMF, Kenneth Rogoff, warns the U.S. is headed for a significant recession. You really have to look at the world, which is in bad shape, he says. It's so very hard for the United States to resist that. I'm only worried that we're not only going to get a mild recession, but I think the chances that we've got a significant recession are pretty high. And a lot of people are struggling with how can the market be so resilient here? Why are stocks looking like they want to trend higher? And it's simple. The market believes that we are headed for a mild recession and that perhaps the worst of it might be behind us. And then just going forward, it's going to be fairly mild and then it will shoot higher from there. But Ken says, not a chance. It's going to be severe. If they really wanted to get inflation down in the 2 to 3% rate on a sustained basis, they might need a Fed funds rate at 6% or higher, he said. I don't think they're going to go there, but that conversation is yet to come. And this is the kind of the academic view that I want you to understand is when academics look at inflation, so let's say it's 5%, they're trying to bring it down to 2. The belief is you have to take the federal funds rate over 5% to be restrictive, but that's really not the case. And history shows that it really isn't a specific number that has to be hit. It just has to go high enough to slow the economy down. And here we can see in this chart the consumer price index in blue and the federal funds rate in red. And you can note that through the 60s and 70s and even into the early 80s, that was kind of the belief and what had to happen for it to work. And you can see the federal funds rate had to move higher and faster than inflation to bring them both down. But notably starting into kind of the mid to late 80s and going forward, we can see periods where the funds rate in red is much higher than the CPI, and it almost doesn't even matter. It just has to go up until it's restrictive, and that's the point where inflation starts to slow down. We can even here look into 2005 and note that the inflation started to slow down and the Fed wasn't even done hiking. Even here in 2018, the Fed's hiking, inflation finally cools off. So no, the notion that Fed has to go to 6% here, well, there's no evidence of that at all. They just have to go high enough until something tells the Fed they need to stop. It's very premature to be thinking about pausing, Powell said at Wednesday's press conference. So people, when they hear lags, they think about a pause. He notes it's very premature in my view to think about or be talking about pausing our rate hike. We have a ways to go, but Powell, we're going to challenge that in a big way here momentarily. As you hear people talking about liquidity in the Treasury market right now, there's still a lot of liquidity in that market. Well, in fact, that's actually just the opposite. There's not a ton of liquidity in the Treasury market. Now, there could be, but there's not at the moment. And mainly this is an issue of the dollar. When you see the dollar really strong and there's a shortage, and that's why the dollar is strong is due to a dollar shortage, then there's going to be a liquidity issue in the Treasury market, because what do you tend to see is people selling Treasuries to get dollars, and that's the flight to safety is people want dollars and they're willing to trade their treasuries for it. In that case, what would we want to see the Fed doing? Well, we'd want to see them perhaps either doing QE or even lowering rates. In fact, the Fed's doing just the opposite, and they're exacerbating this liquidity issue. And pulling that out means you have to constrain the economy and I think create uncertainty around the financial sector. So that would be an add-on to the inflation uncertainty as we move forward here, which I disagree. In responding to Honig's comments, Rogoff argued that rate hikes are much more significant than reducing liquidity in the market. In fact, that is the belief, is that rate hikes are indeed more powerful than quantitative tightening. I think we'll find out soon enough who is the stronger one, but I believe the QT may be the bigger factor. But now let's talk about this dollar shortage and why the rates market actually matters here, because it is something I think a lot of economists overlook, that if indeed we believe there's a dollar shortage and there's evidence to support there is one, then what we need to see is the dollar come down in value. And if you believe the central banks have the sole power to control their currency, which I not being one of those, what you'd want to see is the Fed pause, perhaps even cut a bit, and let foreign central banks catch up with rate hikes, and that should lead to a weaker dollar. But the key here, it's the bond market that really matters in terms of the dollar. Check this out. Here we can see in blue the nominal broad US dollar index, in red the 10-year 3-month yield curve. So this is where we're taking 3-month T-bills and subtracting off the 10-year Treasury yield. And we'll note that is in red. And what we can see is when we have inversions, and down here, you'll notice there's inversions. That's where you start to see yield curve rising and the dollar start to ease off that pressure of it being real strong. Now, notably, why does that happen? Why do we see that? Because what does it mean when the curve steepens? It means rates are falling. And you think about this, how is new money created in our economy? Well, it's created when people borrow. They tend to borrow more money when rates are low. That's how new money is created. And again, that takes the pressure off the dollar. So what we want to see here is we need to see rates come down. In that case, all eyes then become on the Fed, who keeps driving that front end of this curve, that 3-month yield higher by threatening more rate hikes, when in reality, we need that to come down to take pressure off the dollar and ease this dollar shortage. So further evidence, in this chart, we can take that same yield curve data in red, and now we'll just invert it, and now you can see the nice relationship between the dollar and yields, telling us that the Fed has indeed gone way too far. We'll look at that here closer in a moment. But maybe Thomas Homeg is right, but with the interest rate hikes are sure putting a lot of pressure across the board, and they are. And now you can see that exactly how they're doing it. Powell's saying we're going to keep raising rates because we know what to do if we over tighten, we'll cut. It's funny, it's a mirror image of what they were saying a while ago. Well, we don't want to raise rates because we know what to do if there's inflation, but we don't know what to do if there's a recession. And sure enough, they won't know what to do. They'll cut real fast, but it won't make a difference. We'll talk about that in a moment. But first, I want to show you why the bond market is completely convinced that Powell's done, even though he at least claimed at the last press conference he wasn't. Here again is that same 3-month 10-year yield curve now in red, and I've got it inverted so you can see the inversions now up here. And notably, when the federal funds rate goes up and you see this yield curve invert, and now showing twice inverted because I've got the chart inverted, but here's the inversion line is right here. You see it here, 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 and over here. And notice that every time that lines up perfectly with a pause in the federal funds rate, telling us that something between now and December should give the Fed cause to pause. Will it? Well, we'll find out soon enough. Because productivity is terrible, and it's just really wages that are higher than they seem because of changes in working conditions. Employers are distracted by pressures to take on social issues, or is it just a global phenomenon? And I don't know what it is, but even though we do know the answer, Rogoff admitted. But there's a real disconnect between what's going on with growth and what's going on with labor, and really there isn't, because when you understand coming out of this pandemic, what did everyone believe? That the economy was about to take off in a big way. We're going to enter a new bull market. There's this huge demand for labor. And all of a sudden, what happened is this labor wasn't experienced. You know, they didn't have the walk-on and ability just to start doing the job at a high rate of productivity. So what we should see is that wages are high and the productivity is low, and they should line up with each other, because as productivity increases, guess what? Wage increases start to fall. And sure enough, Rogoff, that's exactly what's going on. Check this chart out. Going back to last week, we looked at labor productivity, here shown in blue, which is the output per hour of an employee. And now we've got unit labor costs, which we also looked at last week, shown inverted in red. And you'll notice the wonderful relationship between these. So Ken, what's going on here, my friend, is that businesses overhired. They hired people that weren't very good at their job because they didn't know how to do the job, and the employers had to pay a premium to get them. But guess what we're already starting to see in the labor market? And many of you know this, some big companies are starting to trim staff back. And that's because they're cutting off the people that aren't meeting their productivity standards. That will bring unit labor costs down, and you'll start to see inflation come down with it. And that's what's really going on. But the big factor here is major bank CEOs signal a strong consumer for the holiday season and into the remainder of the year. Rogoff echoed similar sentiments, saying the impact of the Fed's rate hikes is a 2023 story. And the real answer to the question is what's going to happen this holiday season? Because what the market thinks is that we're going to have a pretty decent holiday season. It may not be the best one ever, but it's going to be good enough. And if companies are cutting back on their employees, that means higher profits, higher earnings, and that's going to be a boom for the market. I'm not sure that's how it plays out. I think the consumers retrench. I'd like to know what you think. Do you think this is going to be a booming holiday season? Or do you think this is one we're going to look back and say, wow, that didn't work out real well, and now we're in danger going into the first quarter with big inventory builds? But let's continue on, see what else Rogoff has to say here. He notes that interest rate hikes take a long time to really eat into the underlying economy. And yeah, they hit stocks real quickly, but employment output, lots of surveys of all the literature suggest 6 to 12 quarters. I think he actually meant months, even more, so that I think all lies ahead. He predicted higher borrowing costs would eventually curb monthly job gains and increase unemployment. He also noted the strong labor market data hasn't translated into economic growth or productivity gains. And again, we come back to this notion that the Fed has this magic ability to create and destroy jobs. What they have is the ability to change how people spend, or at least they hope that they can control how people spend. So when you think about what rising rates do, well, what they lead to is, in fact, people having to choose between making payments on their debt or consumption. And that's the big factor here, because we look back at every cycle, and why don't rates have to go up too much? You'll notice they don't have to go up a whole lot before it slows the economy down, and the answer is always the debt. There's always more debt created in the next cycle. The more debt you have, the less ability you have to absorb higher interest rates. That's why the Fed can never get back to some normal rate. It's just not possible. And so when you think about the labor market, it has an impact in the same way. If a consumer is spending more money on debt service, dealing with their credit cards and other revolving debt, that leads to lower consumption. Lower consumption leads to less employment. And what we should see is a chart of that validates it, and we've got one. Here you can see the non-farm payroll report showing on change in thousands of persons, what we report every month and what the non-farm payroll report tells us against the federal funds rate here in red. And what you'll notice, as the funds rate goes up, it does lead to a deceleration in jobs created. And again, there's this notion that the Fed somehow has some magic power to create and destroy jobs. No, what they have again is the power to change how people spend. They can pull demand forward by lowering rates, or they can push demand back by raising rates, and that should lead to a slower job market. Exactly what Powell's been saying is going to happen. The question is, will it happen too fast where he can't react? And I think so. You really have to look at the world, which is in bad shape, Rogoff said, pointing to the mounting signs of recession in Europe, China, and Japan. It's going to be very hard for the United States to resist that. And he's right, because we're in a global synchronized economy. The grim outlook has increased the risk that the U.S. economy suffers a painful and protracted downturn. He worries that not only are we going to get a mild recession, he says, I think the chances we get a significant recession are pretty high. And yet the veteran professor emphasized for the full impact of the Fed's rate hikes won't be felt for a while, given the continued strength of U.S. consumer spending and the typical lag before higher rates hurt unemployment and output. And he's right. If we are looking at a 12-month lag, that means the maximum pain at this point won't be felt till this time next year. And the question, though, is he knows that the consumer is strong as we head into the holiday season, but is there evidence that the consumer is starting to wane on his power? Well, there is. Inflation and recession fears have some holiday shoppers trading down. 72% of consumers plan to look for less expensive alternatives this holiday season as a result of inflation, according to a survey of 2,200 U.S. adults. With inflation at a 4-decade high, consumers have been trading down to less expensive groceries and other necessities for the better part of this year. And again, we ask the question is, why is this? Because the economy is not as good as everybody thinks. If the economy was booming and wages were surging, inflation wouldn't be an issue. But the fact that there is an issue tells us the economy is nowhere near strong as the powers of the Fed and everyone else say it is. Now, with the stock market plunge of recent months further eroding the wealth of the middle and higher income households, the penny pinching is extending to more discretionary purchases, and there's good reason why, because we note advanced retail sales here shown in blue on this chart against the Wilshire 5000 or total U.S. stock market. You can absolutely see the wealth effect. When stocks go down, what happens? Retail sales eventually follow. So there's no doubt that this holiday season could be one that the market's not prepared for, because it could be worse than we thought. We won't know this until actually we're into January and February, and the economic economic data by then should start to look pretty bad. The monetary lags will start hitting somewhere in there, but by March, likely at the latest. And at that point, there's no stopping where this economy is headed. And the Fed will be chasing it down, trying to bring it back under control, but it'll be too little, too late. And with that, we'll see rates back to new lows. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.